This week's topic is paying for healthcare, and it's an important topic to talk about, particularly in light of potential changes that are happening in healthcare legislation. First of all, let's look at healthcare services versus other consumer services. In most industries, consumers have a choice. You have a choice of where you go to purchase your lettuce. You have a choice of what restaurants you go to for dinner. Whatever it is, you have a choice. You can distinguish quality. You can go to the grocery store where you're buying that lettuce, and you can see that that lettuce is moldy or brown or whatever. I don't want to purchase it. That's not good quality. You go to a restaurant, and you can see that there are no cars there, and it's dinner time. Maybe that is an indicator that it's poor quality. Other things in the general marketplace are that you're able to make decisions based on quality and price. So you can determine where do you get the best bang for your buck. Where's the best value for the price that you're paying for something. But you do pay the full price of whatever it is, good or services that you're purchasing. It's different in healthcare. In healthcare, you have less choice because there aren't always a lot of providers, particularly in specialty areas, for a particular service. You're not going to be able to go around your community and find the option of 10 ears, nose, and throat doctors like you can 10 grocery stores within a 20-mile radius. In healthcare, it's a little bit harder to judge quality. You can't always determine whether a certain provider is a good provider, although there are online report cards and things that are available. You can talk to friends, but it's much more difficult than judging the quality of that lettuce at that grocery store. Then you don't always have a lot of choice in terms of who do you go to. Who you go to is often determined by maybe your primary care physician if the gatekeeper model is being used, or if you have an HMO, you have a set list of providers that you have to use. You don't have a lot of choice. But what's different about healthcare is that the purchase is paid for, subsidized by the employers or government agencies. And that protects the consumer, in this case, the patient, from the true cost of the healthcare services. We don't have to pay for the full cost of an MRI or a CAT scan. That is, the majority of that is paid for by the insurance company. The reason that healthcare insurance even exists is based on the concept of risk aversion. We have healthcare insurance and we want healthcare insurance just in case something happens. It's kind of a worst case scenario situation. We don't want to have to use our health insurance, but we have it in case we need it. And that's an important thing. We're willing to pay in the event that something happens, the event that something catastrophic happens. It's our safety net. So the policyholders pass the cost associated with the risk of getting sick to the insurers. So whoever is insuring, they're willing to take that risk because of the large number of subscribers that they have. For example, maybe there's a person who has a large number of health conditions and requires a greater amount of healthcare services. The insurance company is willing to take the risk of having to pay for someone like that because of the large number of people, the other subscribers that they have, that are not likely to need that level of care, and yet they're paying their premiums. So because the cost is spread out over a large number of subscribers, the insurance company is willing to take the risk on covering that person. There are 4 distinct characteristics of insurance that I want to talk about briefly. Pooling of losses, payment for random losses, risk transfer, and indemnification. And in general, insurance works fine when these 4 conditions are present. So the first one is pooling of losses, and that's kind of what I was just talking about. So it's really the heart of what insurance is, and it means that the losses are shared over a large group of individuals so that each individual realizes the average loss of the pool rather than the actual loss incurred. And that allows the insurance companies to be able to predict what the potential costs are. So, for example, you could have a large group of people, and as I was describing earlier, one or two of them need that higher level of care. It's averaged amongst the whole entire group, so that that allows the insurance company to be able to set fees for certain conditions or certain. If you think of it like flipping a coin, you can flip a coin, and every time you flip a coin, it's a 50-50 chance of getting heads or tails. If you flip the coin, you may flip it 10 times and get 8 heads and 2 tails. That isn't spread out over a large pool. If you were to flip that coin 1,000 times, in all likelihood, your average of heads and tails would be close to 50-50. So it works out kind of the same way with insurance companies and pooling of losses. So you can predict that if I flip the coin 1,000 times, I'm going to get close to a 50-50. And that's what the insurance company does with pooling of losses. So they can predict that a particular diagnosis or a particular situation is going to cost X amount of dollars. And that's what they then cover in terms of that diagnosis. Another characteristic is payment for random losses. A random loss is something that's unforeseen, unexpected, and occurs as a result of chance. And insurance is based on the premise that payments are only made for losses that are random. Risk transfer is another characteristic of insurance. And that an insurance plan almost always involves risk transfer, except for self-insurance. And that's when a person or a business elects to not have insurance. We'll talk about that in more detail in a little bit. But risk transfer means that the risk is transferred from the insured to the insurer, which typically is in a better financial position to pay the loss than the insured because of the premiums collected. So the same thing I was just talking about, the insurance company, because they've collected so much in premiums, is in a better position to cover that loss than I am as a patient. I don't have the pool of money to draw from that the insurance company does. So that insurance company is in a better financial position to pay for that loss. Indemnification is the fourth characteristic. In health insurance, indemnification occurs when the insurer pays in whole or in part the insured or the provider for the expenses related to an insured illness or injury. So think of indemnification is the other legal term for that is a hold harmless, so that the person who's incurring these expenses is held harmless. So the insurance covers that. So as I said, insurance works well when these four conditions are present. But if they're not present or if they're violated in any way, that's when problems can arise. Two of the common insurance problems are adverse selection and moral hazard. Adverse selection happens because the people, whether it's individuals or businesses, that are most likely to have the losses are the ones who are also most likely to purchase the insurance in case the loss occurs. So if you have health conditions, you're the most likely to go and purchase health insurance because you want to be covered. So just to give you an example, an otherwise healthy individual without insurance needs to get a costly surgical procedure. That person is more apt to go out and get health insurance if he or she can afford it, versus another similar aged individual who doesn't have that threat of surgery, who may be less likely to purchase insurance. Also, think about age as another one of those factors. A healthy 65-year-old adult is more likely to have insurance or purchase insurance than a healthy 20-year-old adult, even if they have the same risks, same health conditions, whatever it is. That 65-year-old is more likely to have insurance. They're also in a greater risk pool. If the tendency towards adverse selection goes unchecked, a disproportionate number of sick people, or people who are most likely to become sick, are going to be seeking health insurance. And that causes the insurer to experience higher than expected claims. They don't want to have a high pool of people who are sick or likely to use it, because that means that they're going to be paying out a higher amount, because that increase in claims triggers an increase in premiums. So they're going to cause the price of the insurance policy to go up for the healthy person. That's going to cause the healthy person to shop around and try to get something cheaper, leave the plan, or forgo insurance completely. One of the ways that insurance companies have tried to control this adverse selection is by having provisions that are called underwriting provisions. So it's things like smokers being charged a higher premium than non-smokers. Or one of the things that's been done in the past, which is a big part of healthcare reform, is the concept of pre-existing conditions. So in the past, insurance companies were allowed to either charge you more for a pre-existing condition or not cover you for a pre-existing condition. That's something that's been the topic of healthcare debate since the Affordable Care Act, and now the Trump Care Act, however that plays out. Because insurers want to shy away from these larger claims, and this was a big issue prior in the we'll say before the mid 90s. It was when the Health Insurance Portability and Accountability Act, or HIPAA, came about. In addition to things like privacy laws, privacy regulations, HIPAA set national standards that can be modified within limits by states, but it was regarding the provisions that can be included in health insurance policies. So they set forth that there's only certain conditions under which insurance can be denied from a person, or when you're getting insurance from your employers can't refuse a particular person from being able to get insurance. So, for example, many employers have offer healthcare insurance, but they can't say, no, you're a smoker, you can't have that insurance, or you're overweight, you have to pay more because you're in a bigger risk pool. So that was an important thing under HIPAA. Another one of the common insurance problems is the moral hazard. And moral hazard is based on the premise that payments are made only for random unforeseen losses. So, in other types of insurance, people can cause losses. So think of the person who can't pay their mortgage, they have homeowners insurance, they do something illegal and burn down their house to be able to get the payment. You can't really do that in healthcare. So you're not going to go out and intentionally get yourself hurt so you can get services. But what happens in healthcare is that people elect to undergo procedures or seek healthcare services that aren't necessarily required. So they might, if you had to pay for an MRI out of your pocket, you might be more prone to weigh the options of, is this really necessary, if you have to pay for it on your own or you have to pay a portion of it. Otherwise, it's like, okay, the doctor's recommending it, I'm not going to have to pay for it. Well, let's do it. And insurance companies often set it up that way. Like, I can tell you, for an example, before my knee surgery, you have to first have the x-rays, then you have to have the CAT scan, then you have to have the MRI, and then you have to have, physical therapy or whatever it is. They set it up so that you have to undergo all of these treatments or services before you can get to a certain point. Also, when services are being paid for, if your healthcare is covered, people are less likely to take preventative measures or actions. Well, I don't really need to stop smoking. If something happens, my insurance is going to cover it. That's an extreme example, but I think you understand what I mean. So it causes this greater consumption of services. The insurance company have built in deductibles and copays to help address this, so that a portion of the payment is coming from the pocket of the patient or the consumer, and that can help address some of these overutilization of services.